In a few sentences, let me introduce myself. This is Orhan Erdem from the University Department of Economics. I'm also the director of Master of Finance in the University also. I'm working in two fields mainly. First one is real estate economics and real estate finance and credit, mortgage credits, etc. And the second field is this one, behavioral economics. So this study is mainly based on behavioral economics, so how people behave and when they encounter risks. This work is on mutual funds. So the mutual funds, the definition of mutual fund is an asset established to manage a portfolio of capital market instruments. So they may be based on real estate, gold, or other precious metals. So people buy and sell these mutual funds. And the mutual fund industry is... Okay, there are two types of mutual funds, mainly. First one is type A mutual funds, the second one is type B mutual funds. Type A mutual funds, so they invest at least 25% of their total assets at all times into securities to Turkish companies, so they may be shares or stocks, etc. And the others are B-type, so there's no definition for B-type. So this is the market size. So this is, first I will, let me say, I'm going to give intuition about the market size, what is mutual funds and the share of mutual funds. So this is the market size of mutual funds. Type A funds, they are very small share, it's $1.5 billion Turkish lira, but it's around 5%. The rest is type B mutual fund, it's 95% of the whole market. So even though type A mutual fund is a small share, the share is growing at an enormous speed. And this is the composition of mutual funds. As I said, 25% at least must be shares or stocks. So this is the case in Turkey. Type A mutual funds, they invest around 60% to shares. And this red area is public debt instruments, which are government bonds, etc. And the green one is reverse repo. And type B mutual fund, there's almost no shares, no stocks. So they are mainly on reverse repo and public debt instruments. And this is the total composition of funds. This is the general picture of the market. So this is just an example of the market. Let me show you the portfolio structure of exchange traded funds. So not all the funds, they do not need to invest, they do not need to, let me say, trade in exchange market, but there are 12 mutual funds, they are traded on exchange market, Istanbul Stock Exchange. But there are also lots of, like, I think around 120 mutual funds that are not traded in Istanbul Stock Exchange. So, for example, bizim menkul değerler, they invest heavily on stocks, 100% on stocks. There's also like İşletme Finance. Kuwait Türk, for example, it's the other way around. They invest 100% to other instruments, which are probably gold, which are probably precious metals. Okay, we do not know exactly, but we know that Kuwait Türk invest heavily on precious metals. But the others, they are A-type, for example, they are generally heavily on stocks. B-types, they are generally heavily on T-bills or reverse repo, etc. So this is the general picture of the portfolio structure of exchange-traded funds in Turkey. Okay, this was the general picture of the market. So main idea of this paper is based on the behaviors of investors or behavior of managers. So there are three people which are very important in behavioral economics: Kahneman, Schifrin, and Ariely. Kahneman and Tversky, they have a Nobel Prize in 2002. They are psychologists, by the way. They are not economists, but they have a Nobel Prize in economics, just because of their contribution, psychological contribution to economics. They say, for example, a person who is not peaceful about his losses would be very like to gamble. if you are in a, let's say, desperate position, if you are a loser, so you can gamble at times when you wouldn't do otherwise. So there are very lots of experiments that prove this setting. So this was Kahneman's idea. And Schifrin all says similar stuff. They argue that concentration of loss realization in December, so there are loss realizations at all months normally, January, February, March, April, May. But interestingly, most of the losses they are realized on December just because people at the end of the year, so they give their account balances, so because, and their salaries, wages depend on their performance on December. So which is not consistent or full rational behavior. And ideally, by the way, they are all Jewish, interestingly.
Well, the issue is money.
Psychological money. They are Jewish, and they say almost on all the conferences that they are Jewish. For example, this guy has a burn on his face. All the time he says that this burn is because of the Palestinian people, etc. He's very Jewish, hard Jewish. Anyhow, but his ideas, experiments are interesting. So he made an experiment in India, which is very related with the concept. He gave people some premiums depending on their performance. For example, I'm counting pencils, or I'm carrying pencils from here to here. So your premium depends on how many pencils you carry from here to here. It's a very mechanical experiment. So when you increase the premium, the performance increases, which is logical. But for example, he showed that in mental experiments, in mental designs, in puzzles, for example, when you increase the premium, the performance decreases, which is interesting. And he says that it's just because of the money. When people concentrate on money, they lose their concentration on mental works, which is very interesting. I mean, he has a graph shows the graph. Okay, the graph shows that when premium increases first from small to medium, the performance increases a little. But when you increase the premium from medium to large, performance decreases almost half, up to almost half, from 100 to 55%, etc., which is very interesting. So he says that giving premium to people, depending on performance on their mental abilities, is very dangerous. And he explains the financial crisis, 2008 financial crisis, with these experiments. He says that the managers, the CEOs of financial companies, they have large amount of premiums, like $1 million of premiums. So he says that when you give $1 million premium to a man, I mean, he loses his concentration to increase the return. So these are just the very simple stuff on this issue.
Is the last guy also a psychologist?
No, he's economist. These are two, yes, economist, this is psychologist.
I'm reading his book, it is very interesting.
Which one?
Predictably rational.
Which one?
Oh, yeah.
Akıl dışı hemen görülebilir diye. There's a book, which is very interesting, really. So the idea of my paper, let's say my work, is based on this experiment. When you increase the premium, when you give premiums, people lose their rational behavior. Okay, let's see. This paper is very important in my setting because this so that losers in the first part of the year, he says that if there are losers in the first part of the year, they increase their risk relative to the previous part of the year in the second part of the year. And these two guys support this information, and this guy has some contradictory results. Let me show what we do. Okay. So the idea is simple. We try to find whether being a loser or being a winner in the first part of the year. I will show what is winner and what is loser in a few minutes. If you are a loser up to June, for example, you increase your risk. If you are a winner in the first part of the year, which means that you earn higher returns on your stocks, you decrease your risk. So this is the simple idea. I will show in details. Our contribution is twofold. First one, we reveal the performance of mutual funds in Turkey, which is not publicly available. And second, a country-specific example of Turkey on mutual funds, and this is some kind of behavioral contribution to the literature. This is descriptive statistics of A-type mutual funds. So my study is mainly on A-type mutual funds, not B-type, because they invest on stocks. And these are their average number of stocks in funds, total number of different stocks in funds. And this is not so much of great importance. This is interesting before starting the mechanics. This is the return of mutual funds in Turkey by every year. And this is the return of Istanbul Stock Exchange, İMKB'yiz. These are the returns, and this is the inflation. So returns of mutual funds is higher in 2002, in 2003, and then it started to decrease. It was never higher again by inflation. There is no real return, let's say, in mutual funds. There are some years, for example, here it is higher than Istanbul Stock Exchange, but when you're concerned of inflation, there is no real return above Istanbul Stock Exchange. Okay, this is what we do. So methodology, so we define a return, JMY, which is the, let me say, the gross return up to month end. So this is the return of January, this is the return of February, this is the return of March, etc., etc., minus 1. So it is the gross return up to month end. For example, this month can be April, August, etc. So this is the return of the first 5 months, first 6 months, and 7 months. So we change this end all the time. And we try to understand, we divide, let me say, we divide the whole funds into two parts, winners and losers. Winners are those funds whose gross return is higher than the rest, and the others are the losers. So this is the definition of being a winner and being a loser.
Are these closed-end or open-end funds?
Open-end funds. And the second definition, there are just two definitions in the paper. The first one is the gross return, so we define losers and winners. And this is the risk-adjusted return. So this is just a simple definition or variation. So this is just standard deviation from month. So this is the first standard deviation up to month end. For example, this is the volatility up to June. This is the volatility from June to December. So the division shows the relative frequency or relative, let me say, measurement of second part to the first part. So if this is higher, this means that the standard deviation or volatility increase. If this is low, which means that the volatility decrease in the second part of the year. So this is the volatility in the first part of the year, this is the volatility in the second part of the year, just simple definition. So the idea is simple, the idea of paper. Let's see the winners, let's see the losers, if their risk-adjusted return increased or decreased. This is the simple idea. So, okay, these are the results, the first result. There are two tables I will show you. This is the first table. So, okay, we ranked all the 135 mutual funds. We divide the list according to the median concerning the return definition. Remember the return definition. So the upper part is the winners, the lower part is the losers. So we try to understand if losers or winners have low risk-adjusted return or high risk-adjusted return. If it is high, which means that losers increase the risk. If this is low, which means that losers decrease the risk. So this is the idea. So normally they must be 25%, 25%, 25%, 25% if they are trading normal conditions. So since this is higher than 28.8, this is higher than this one, which means that losers in the first part of the year increase their risk in the second part of the year, which is not rational, just because they increase their risk not to lose their premiums, because at the end of the year they are going to be given premiums, but they are not going to be given, for example, malus. There are bonuses, but there is no maluses, there is no punishment. So they increase the risk just not to lose their premiums in spite of the investors. I mean, they don't care me. They have my money. They increase their risk. I'm not aware of the fact, but they just increase this just because not to lose premiums. And let's see, these are the months. So this is 1 to January, February, April, January, April, March, April. So when we divide the year from April to December, so this is the result. This is April, December again. This is this is November. So this is the end of the first part. This is the end of the second part. So this is again April, December. So it is higher again. This is May, October. This is higher again. This is May, December. It's again higher. So losers all the time increase their risk. In spite of the investors. Investors do not know this fact. And let's see the winners. If higher return winners have 25, there is no problem. And we see, but it's the other way around. Higher return winners, that we say winners, they decrease their risk in spite of me. Just because not to lose their premiums, because they have an aim, they have an objective. For example, they are going to be given, I don't know, $1 million Turkish liras of bonus when they have, for example, achieved their goal. But they decrease the risk just because not to lose the premium. So it's obvious that all the losers, by all the months, they increase their risk. All the winners, at all months, they decrease their risk. There is almost no exception. So then this is when we divide the winners and the losers depending on the median. And this is the second table. Okay, these are, I mentioned, risk altering behavior is most, we cannot project it. And again, there is one point, there is one more point. Let's compare this. So these are the risk altering losers, these are the risk altering winners. And this is always higher than the winners also, which means that risk altering is observed, sure. Also risk altering behavior is also observed mainly on losers, not the winners. So these are risk altering losers, these are risk altering winners. And also there is a third result, risk altering losers are higher than risk altering winners because they are in a desperate position. This is the second table and the last table. So we again rank the returns from highest to lowest, but this time there are four quartiles. Okay, so we extracted the middle two quartiles. So there is extreme winners and extreme losers. So not the median, we use the quartiles. The picture is generally more or less the same, but there is small exceptions. So what we expect is to see 25% in all cells, but it is different. Again, losers increase their risk almost in most of the time, but this time it's not the case. This time again, it's not the case. In general, losers increase the risk. So this is first result. In general, again, winners decrease the risk. There are no exceptions. And again, the third result is, in general, risk-altering losers is higher than risk-altering winners. So this is the third result. Okay, so these are the main idea of the paper. There are also more details, but the general idea is simple. The general idea is that the managers of mutual funds, they increase their risk to get the premium, or sometimes they decrease the risk just to get the premium in spite of the investors. Investors do not know this fact. Because at the end of the year they have an objective. When this objective is met, they get their premiums. And this is in fact is not rational. It's rational in their respect, not in my respect anyhow. So these are the comments of the second table again. This is the conclusion. Okay, I tried to be as short as possible. This is simply in general the idea of this paper. This paper is submitted to İşletme Finance and they accepted it. So it's going to be published in a few months.
Teşekkür ederiz.
Rica ederim. Biraz hızlı mı oldu bilmiyorum ama çok da
güzel oldu.
Şey yapmayayım, sıkmayayım sizi.